Pinch punch, it's the 1st of the month, Tuesday the 1st of Feb. I'm FX Plu, and Happy New Year to my Chinese friends and followers, or Sing Yen Kuai Lu if you're a little bit fluent like me. Shame on you if you thought I was only good for a bit of franglais. I'm just here quietly rocking a wee bit of Chinglish as well. Don't you worry about that. Of course, no offence intended. But anyway, city traders who have been polled about this week's MPC meeting, they're convinced of another 25 basis point rate hike on Thursday. The latest official inflation data has put the headline number at 5.4%, which is the highest since '92, and prices are continuing to rise. So a rate hike is now 100% priced into the market. That's up from last week when it was 90% priced in. And this looks like it'll be the first consecutive rate hike since 2004. Speculation is growing about where rates will be by year end. 1.75% is possible, but most see 1.25% more likely by the end of Q4. There is still a slim chance that some votes may be swayed towards a wait and see outcome, as a dip in growth is pretty likely to follow given all the factors in play. But on balance, it's highly likely that we'll see the second rate hike of the cycle. Yesterday, sterling recovered some of the lost ground to the dollar from last week. We touched 134.60, but we dipped to 119.70 against the euro. Over in the US, the latest growth figures show accelerated growth since the start of Q4, and that is leading to higher and higher inflation. Many analysts are calling that up to 7% before beginning to subside. So Fed policy may well take a little while to get a grip, and there's a degree of speculation that they may kick off with a 50 basis point rate hike next month, which would be unusual, but given the size of the task ahead of them, the vote may reflect a motivation to catch up some of the way that they've fallen behind the inflationary curve. Prices have risen at an unprecedented rate over the past 9 months or so, and it's very unlikely that inflation will be brought back under control in the next 9 months. So the Fed may need to call for a little moderation in the employment market that is already pretty tight. Wage demands are beginning to increase, and the Fed will no doubt be concerned about workers basing their demands on 7% inflation, while their policy intends to bring that back down much closer to the 2% Fed target. Yesterday, the dollar index corrected from last week. We slipped to 96.50, and that drop may have coincided with lower expectations for Friday's non-farm payroll number. The mean expectation is now for a headline of 165,000 new jobs in January. So everything to play for in the sweepstake then. Oh, I can't wait.
If you do not have a clue, then just tweet through and ask FX Blue.